Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off, then if you have any questions, you can ask our speaker during her presentation or after her presentation. I have great pleasure of welcoming here Professor Maria Loumioti. Maria is an associate professor of accounting at the University of Texas at Dallas. Her research has been published in top-ranking journals in accounting such as Review of Accounting Studies, Journal of Accounting and Economics, and the Journal of Accounting Research. She holds a doctorate in business administration from Harvard Business School and a BBA in accounting and finance from Athens University of Economics and Business. She was previously an assistant professor at the University of Texas at Dallas, assistant professor at the University of Southern California, and a visiting assistant professor at MIT. Now we will start our seminar with dear Professor Maria.
Okay, thank you so much, Mohammed. Good afternoon, everybody. Thank you for the kind invitation to present to this audience. I hope it was in person, but at least that's a good time to connect on very different parts of the world. As Mohammed suggested, my name is Maria Loumioti. I'm an associate professor at UT Dallas. And today I will talk about the growth of direct lending as a new and important credit market segment and its implications for access to credit. So just to make sure we are all on the same page, by direct lending, I defined lending by non-bank institutional investors. So traditionally, the large corporate loan market was dominated by banks, and banks were responsible for underwriting corporate loans. However, over the past 10 years, we have seen more and more of this activity, of the lending activity, especially in the middle market and in the large corporate market, large leveraged corporate market coming from non-bank institutional investors, such as insurance firms, private equity investment management firms like Golub, Ares, Apollo, Management, etc. So instead of banks underwriting these deals, these loan deals, now we have an increasingly higher number of non-bank institutional investors lending directly to corporations. So this study is organized across two research questions. So first, I try to understand whether direct lending expanded the credit space and whether this activity gave rise to adverse selection cost in the private debt market. So as I mentioned before, this credit market segment, direct lending, has been one of the most rapidly growing and expanding segments in the private debt market. So it has grown by more than 20% since 2009. The total size of the market as of 2017 is about 600 billion. And in terms of economic significance, if we consider the established securitized loan market, where loans are issued and sold to securitized entities, and compare this size, the size of the securitization, the securitized loan market with direct loan funds, this is about 23%. So direct loan funds issued over the 2010-2017 period account for about 23% of the established securitized loan market. So this is an important and economically important and especially rapidly growing credit market segment. Despite its importance, we have very little evidence on the drivers and characteristics of this market. So this is the purpose of the study. This is where I come in and trying to fill this gap in the literature. To address my research questions, I collect direct loan data using three databases. So just in a nutshell to describe what I did, my main database that I work is Preqin. Preqin has been used primarily in finance to examine private equity and hedge fund investments. However, since 2014, Preqin also covers direct loan fund activity. So I use, I got data from Preqin, and this data is granular, is at the loan level. So for every loan identified in Preqin, I try to retrieve loan characteristics in DealScan or in S&P Capital IQ. So I go line by line in Preqin and try to see whether this loan can be also identified as a direct loan, either in DealScan or Capital IQ. So the important thing is here is that for a loan to be in my sample, it has to be identified as a direct loan in Preqin, and both in Preqin and DealScan or Capital IQ. So this way I try to avoid misclassification bias of a loan being erroneously categorized as a direct loan. From my sample, I exclude loans that are linked to acquisitions or public to private deals. So basically, direct loans where the non-bank institutional investors issued these loans as part of a larger acquisition deal or public to private deal. This is because typically in this type of larger deals, the non-bank institutional investor will also buy equity in the firm, so it will issue loans and will issue also equity. So that's a little bit of a mixed investment on both the liability and the equity side of the company. So I would like to have in my treatment sample, in the direct loan sample, just straight loans that a bank should have issued in the traditional corporate loan market. So I exclude loans related to acquisition and public to private deals for this reason. I just don't want the lender to have also an equity stake in the borrower. And for this reason, I also exclude deals where I identify that the non-bank institutional lender is also a prior investor in this company. So for this reason, so I don't want to have a lender that also has an equity stake and has lent to the same company. So the final sample I have after this cleaning, the data cleaning, includes 756 direct loans issued by 89 direct lenders over the 2003-2016 period. So I compared these loans to three control groups of loans, and I try to build these control loan groups to make the loans in these groups comparable to my treatment group. So the first control loan group includes institutional loans where that are issued by a bank's private equity or investment arm. So this is a control group similar to the one used in Fang et al. 2013. So basically what I'm trying here to do is, okay, so I compare direct loans to loans that are issued by banks, but not by the banks themselves, but by their private equity or investment arm. So not by Morgan Stanley, but just by Morgan Capital. So by the investment arm of the bank. The second control loan group includes highly institutional loans, primarily sold to institutional lenders. So these are loans that are heavily sold to institutional lenders, issued by banks, but sold heavily to institutional lenders. So more than 50% of the loan balance will end up being sold to institutional lenders. And the third control group includes institutional loans where the direct lenders participate in the syndicate, in the initial syndicate. So for example, GoLoop is one of the direct lenders in my sample. One potential loan in my control group will be a bank-originated institutional loan where GoLoop participates in, where GoLoop buys tranches of this deal. So all of these control loan groups are leveraged loans, they group leveraged loans. The results are robust to just summing up all these control loan groups into one big group of loans. But basically, I'm trying to compare the direct loans that are issued directly by non-bank institutional lenders to borrowers to kind of what we call leverage loans, so high yield loans where non-bank lenders have been traditionally active in participating. They were not issuing them, but from 2000 till now, they're actively buying loans. And again, I mean, the idea is actually try to compare apples to apples when I construct my control group of loans. Again, you know, if you have any questions about the data, about the sample, or about some definitions, just let me know so to make sure we're on the same page. Okay. Now, based on the descriptive statistics of my sample, I also find that the direct lending activity is growing rapidly, especially post-2013, outpacing the growth of any other similar credit market segment. So here with the dotted black line, you see the growth in direct lending as a percentage of loans issued by the PE or investment management arm of a bank. With the green line here, you see the growth in direct lending as a percentage of institutional lending, where direct lenders are participating, so they don't originate a loan, but they buy tranches. And you see a similar growth pattern when I compare direct lending activity to the issuance of highly institutional loans. So in either of my control group samples, I find that direct lending activity has outpaced the growth of the market significantly, and especially post-2013. So the growth of the activity, so here you can see this with the dark line. This is the total direct loan volume as this appears in my sample. And this is in the primary y-axis. So you see that it has reached about 18 billion. So that's the loans I have in my sample, the issuance as of 2016. And not only the total market is growing, but also the average deal, the average direct loan deal has been increasing. So if you see in the early years, the average, and that's in the secondary y-axis, so the average loan deal in 2009 or 2010 was about 70, 80 million, and it has grown to about 160 as of 2016. So basically that means that not only the market has expanded, but also the type of deals that direct lenders go after has also gone from the traditional middle market. So middle market includes loans up to 100 million to the large corporate loan market. Now, a lot of the direct lending activity is driven by finance firms. So we see here the direct loan split by direct lender type. So we have a lot of loans issued in my sample issued by finance firms. But also we see a lot of this activity coming from private equity firms and investment management firms. Now, interestingly, the mix of direct lenders over time changes. So we see, for example, here, how much of the direct loan market is driven by institutional investors, so private equity firms, investment management firms, hedge funds, comparing to the traditional market, as we see, the finance companies. So we see that over time, there is an increasing and positive trend of more and more activity in this market coming from the private equity firms and investment management firms, and less so from the finance firms. So while traditionally we had finance firms, a little bit activity from the insurance firms driving the growth in this market, and I'm talking in the early years, 2003 to 2010, we see that actually the mix of lenders, the mixture of these lenders in this market has changed significantly over time, and now is primarily influenced by lending decisions from private equity firms and investment management firms. Just going a little bit to see, okay, who are these players that are driving the growth of the market? We have a lot of activity coming from, the old and traditional direct lender, the GE Capital. We have, I have a lot of deals from Madison Capital, Next Capital. Going to the private equity firms, we see Monroe, Golub, Apollo being very active in this market. Also Ares, Alcentra, Guggenheim, extending lending directly to borrowers. And I have also some deals from hedge funds such as Oaktree and Silver Point Capital. The main activity, as you can imagine, is coming from the US. So the vast majority of my sample loans are originating in the US, but we also see some of this activity in United Kingdom and Europe. The results are robust. So the results I'm going to show you in a while are robust, just focusing on US firms, but I'm using the full sample in my primary analysis. Now, to address the first research question of whether direct lending expanded the credit space, on the one hand, one would expect that institutional lenders, after being very active in the traditional syndicated market, the bank-dominated syndicated market, will leverage these relationships with the borrowers and will try to attract borrowers that they have previously participated in their deals. Another approach to how direct lenders gained deals and gained business in this market is that they may actually have reached out to borrowers that the financial institutions, so banks, did not traditionally or can no longer serve, primarily due to the rapid consolidation that we have seen post-crisis in the US market, and due to the greater regulation that banks have to abide by. Post-credit crisis, the post-2008 crisis, we see a lot of structural changes in the market, the consolidation. So we see a lot of smaller banks being acquired by the larger banks. But we also see, like the Dodd-Frank, more restrictive regulations being imposed on the bank's activity, especially in the high yield market. So for these reasons, one hypothesis is that direct lenders, these non-bank institutional lenders, saw a space, an open space, and try to fill this void in the credit markets. So to test my this hypothesis, I use multiple variables to proxy for the consolidation of the market, access to credit, regulatory pressure, and borrower characteristics. In the first three specifications of my analysis, the dependent variable is direct loan, 1, which is a dummy variable equals 1 if the loan is a direct loan, and 0 whether it's a loan issued by the PE, the private equity, or the institutional management, so investment management arm of the bank. In the next three specifications, the control group I use are the highly institutional loans, and in the last three specifications, the control group I use are institutional loans originated by banks where direct lenders act as participants. So for regulatory pressure, I use two proxies. I use the non-performing loans on the bank's balance sheets and bank's litigation risk. So in those two proxies have been positively associated with greater regulatory pressure on banks. As a proxy of consolidation of the market, I use the bank's M&A activity in the state or the country, if we talk about international borrowers, in the state of or the country of the borrower's headquarters. And across more specifications, across most analysis, across most regressions, I find a positive association between regulatory pressure, either brought by banks' non-performing loans or bank litigation risk, with the probability of a direct loan issuance. Now, going to the bank's M&A activity, I also find that in, again, most specifications, the consolidation has expanded, has given space to direct lending activity. I also look at alternative ways that borrowers can access credit. So I'm looking at the bank loan issuance over a period. I'm also looking at CLO issuance. I look at GDP growth as a proxy of bank lending activity. So what I find is actually that direct lenders seems to be more active in periods of weak bank and securitization issuance. So that means they are primarily going after deals when other ways of getting access to capital, like through banks or through CLOs or through securitization, these alternative ways are absent. And looking at the characteristics of the borrowers, I find that they primarily target informationally opaque borrowers, so borrowers that maybe these are the first-time borrowers. They are small firms with no profits, so they are loss-making firms. So these are actually borrowers where traditionally banks will want to attract. This is too risky. These are too risky for the banks. So collectively, I see that direct lenders, independent of the control group I use, direct lenders seems to be more active in periods of greater regulatory pressure, periods and regions of greater consolidation, bank consolidation activity, when alternative financing ways in the private debt market are absent, and they primarily target informationally opaque borrowers. So collectively, these findings support the hypothesis that direct lenders likely expanded the credit space. All the variables I use from regulatory pressure, consolidation, information opacity, these are all being linked in prior studies to credit rationing. These are typically borrowers or periods in the credit cycle where we see less activity, less lending activity by banks. So it seems that now in these regions, in these periods of the credit cycle, direct lenders come in to fill the void and expand the credit space to borrowers that either banks do not want to lend in, or they were never good targets for the banks. Looking at the characteristics of direct loans, I find that direct loans have a higher interest rate, controlling for loan and borrower characteristics. So basically, that means that direct lenders get a compensation for the risk that they are taking to fill the void, to act as lenders of last resort and fill the void in the market. And interestingly, I find that direct lenders are not interested so much in exercising control rights through covenants. So direct loans are mostly covenant light. but they actually use equity warrants as collateral. So that means that the collateral they prefer the borrowers to pledge, direct lenders prefer the borrowers to pledge, is equity stakes warrants in the deal. And you know, in a simple English, that means that, well, if the borrower goes under, direct lenders, these institutional, non-bank institutional investors, the private equity, the investment management firms, they are not interested in start liquidating like assets, like buildings, inventory. They are not into this business. What they want to do is actually take the company and run it as equity holders. So basically what they traditionally know how to do, like a private equity company that is expanding to direct lending, it's not going to start liquidating a borrower's assets. If a company goes under, they will just use this collateral, the equity warrants as collateral, and take the deal and take the company as in their equity portfolio. Any questions so far? Is everything clear? Okay. All right. So going now to my the second question of whether direct lending exacerbates adverse selection cost. Again, and by adverse selection cost, I mean whether they screen and pick borrowers that they shouldn't lend to. So they actually pick the lemons and they lend to lemons. On one hand, we can see that because these lenders are unregulated, they can take greater risks, and similar to many securitization markets, they may actually do pick up lemons. Maybe they actually have companies that you know, they shouldn't get access to credit. They should be rationed credit. The other factor that leads to this hypothesis is that, as you have seen in the structure of the sample, we have a lot of direct lenders. So direct lending space remains highly competitive. We don't have kind of dominant direct lenders that control the market. So that means that we may have a lot of lenders coming in and giving, in order to attract borrowers, they may actually give them more favorable terms, which actually will also lead to low quality direct loans. On the other hand, there are also some factors that may suggest that direct lenders are not actually picking lemons. So the first is skin in the game. So unlike banks that typically originate a loan and then they sell it in the secondary market, direct loans are very liquid. They're not sold. So once a direct lender issues the loan, he will have to keep it to maturity. So he has a stake. So he has a stake in the game, skin in the game. This long-term investment horizons and skin in the game is likely not going to lead to lower actually adverse selection cost. So typically, as you know, the adverse selection cost upon loan issuance are not directly observable. So we approach it for adverse selection cost at issuance by looking at ex post credit performance of loans. So I use three approaches for direct loan performance. I use the probability of bankruptcy over the 2-year period post credit issuance. I look at the probability of a credit rating downgrade and the loan returns. If a loan is traded, I also look at the loan returns of the borrower. So if borrower has loans that are traded, I also look at the loan returns of the borrower. So independent of which proxy of ex post credit performance I use, I find very weak association between direct lending and ex post credit performance when I compare these with other similar high yield bank originated loans. So for example, you see here that out of the 6 specifications, I get a significant results that direct loans are, direct lending is negatively associated with bankruptcy probability in 2 out of 3 specifications. So there is a weak evidence. So it seems that actually direct loans are of similar quality to other high yield institutional loans. So it seems that direct lenders do not issue loans that are quality or of any different exposed performance comparing to what banks originate traditionally in the high yield market. So in supplemental tests, and some of this I mentioned already, I find that these results are robust when I restrict my sample to US companies or only publicly listed companies, so excluding private firms. This is because data coverage for private firms can be more noisy, so I exclude those to make sure that this noise doesn't drive my results. I also use a sample of loans matched on loan size, maturity, and whether the borrower, whether the loan is collateralized, and whether the borrower is a private firm. To mitigate the concern that the results are driven by the fact that most of the loans, of the direct loans, are middle market loans, as we have seen earlier, whereas banks traditionally cater to the large corporate loan market. So I just didn't want to have the fact that direct lenders will cater also to middle market, so very different market, whereas banks are primarily serving the large corporate market. I don't want these inconsistencies to drive the results. So for this reason, I use this matched sample to compare apples to apples. And the other important finding is that I also see that the results, and especially on exposed credit issuance, are primarily driven by private equity and investment management firms. So actually, direct loans issued by these non-bank lenders, private equity and investment management firms, are of a better quality. So the results have a lot to do with which lender type we are focusing on. We see direct loans issued by finance companies or hedge funds have similar performance with bank-originated high-yield loans. But on the other side, we see that when private equity and investment management firms act and lend in this market, they are able to issue good quality loans. So based on this, I'm trying a little bit to understand how these firms, how investment, non-institutional, these institutional investors, especially investment management firms and private equity firms, source these deals. So it seems that, and this is what this analysis here tells us, it seems that a lot of the direct lending activity from these lenders, from these direct lenders, is coming in from industries, from borrowers in industries where they have a high expertise. So when I look at their equity portfolio that they manage, I see that they actually go after borrowers in industries where they have a greater expertise. So that means that direct lenders do not actually just randomly start sourcing credit to this, providing credit to this market and sourcing borrowers. They actually go in industries and in sectors where they feel most comfortable with. They have greater experience and they have greater know-how. And indeed, when they actually lend to borrowers in industries where they have a greater expertise, they are able to get better loans, better quality loans. So loans to borrowers that are less likely to go bankrupt post-issuance. And actually, this activity serves them serves their core business, basically serves the performance of the equity portfolio. I didn't spend much time before going over the results on loan characteristics and especially spread. But on average, a direct loan has about, can give over LIBOR, over the base rate, can give between 300 to 400 basis points, so like 3 or 4% returns. So if you compare this to the private equity returns of the equity portfolio, that can be 9 or 10%, that actually means that, well, if institutional investors go into this market, they are actually, the total returns are harmed, they decrease, because if they were going and expand to the equity market, they could get a return of 9, 10%, but they go to the direct lending to diversify, and they get return of 3% to 4%. So the total returns are lower. So when I talk to direct lenders, okay, so that this doesn't make sense, your total returns are actually lower. So one of the things is that they say that, well, now banks, because of new regulation and a new structure of the banks, of the banking sector, banks don't issue a lot of leveraged high yield loans. So we have to do this activity ourselves because our investors are looking for diversification. So our investors don't only want us to hold equity, but also hold debt, high yield debt. Banks now, because of all these reasons, they don't issue this debt, we have to issue this. But also another thing is that they get some additional information about their core activities. So when you are issuing loans as a lender, you get access to private information about the borrowers. So by institutional investors being active in the direct lending market, they can get private information about the borrowers. So we actually see that wherever in industries where the institutional investors, the institutional lenders are active in their direct lending, we see that they increase their industry allocation. So it seems that they kind of leverage this private information that they get through the direct lending activity to build and influence their equity portfolio. So basically, the idea of why these investment management and private equity firms expanding to the lending side, it's not so much driven by returns, but more so to get access to private information. And they did so not by just randomly going after borrowers, but actually go after industries they feel most comfortable with. In the last set of analysis, I'm trying to say, okay, so is there, from the bank side, is there any regulatory arbitrage going on? So now banks that are mostly pressured by new regulations not to lend to informationally opaque and leveraged borrowers, do they find a way to do so through the direct lenders? So here I see that, here I look at bank loans, the volume of bank loans to direct lenders. So how much of bank loans of credit direct lenders got from banks to finance their operations. And I actually see that, so traditionally, this type of banks do not finance this type of lenders. This is a risky business. They won't go and finance private equity or hedge fund. This is risky for the banks. But I actually find that post-financial crisis, there's more bank loans being channeled to direct lenders. So it seems that post-crisis, instead of banks going and lend directly to leverage high-yield companies, they lend to direct lenders, and direct lenders then channel these funds to highly leveraged companies. So it seems that post Dodd-Frank, there is some regulatory arbitrage going on from the banks and how direct lenders finance operation to increase their direct lending activity. So to conclude, I have presented some descriptive statistics and empirical analysis on showing that direct lending is the fastest growing credit market segment. I find that this activity, direct lending activity, is positively associated with greater regulatory pressure on the banks, higher consolidation in the banking sector, and periods of weak bank and securitized debt issuance. Direct lenders cater primarily to informationally opaque borrowers, and collectively, these results suggest that they are likely there in this market to expand the credit space. I find no evidence that direct lenders issue credit to lemons. It doesn't seem that adverse selection cost is a problem in this market. So with these results, I contribute to the industry of shadow banking and fintech lending, so alternative lending, non-bank lending, the industry that explores changes in bank lending activities that can give rise to new financial intermediaries, and the established literature on the credit terms of institutional corporate loans. Okay, so that was all for today. Thank you so much. If you have any questions, feel free.
Thank you very much, dear Professor Maria, for your contribution and your effort. It's really an excellent paper and excellent presentation. Thank you very much. Now, if anyone have any question, you can open your mic and ask your question. Yes. Ali عبد المتجلي. Ali. If any questions, you can open your mic and ask your question.
Hi. Thank you very much for your presentation. My name is Liu. I'm from Malaysia. So I would like to ask something regarding the direct lending. So can we actually argue that the financial technology or the fintech actually accelerate the direct lending, and also when it does that, then it also creates a lot of adverse selection problems, and also, as what you presented, increase the credit space. So, so is that something that can be put forward? Thank you.
Thank you. Yeah. So one of the things that unfortunately I cannot do with my study is distinguish on the technology, direct lenders, or the technology they employ to source the deals. It is the case, as you suggested, a lot of non-bank institutional lenders will enter this segment using big data or fintech. But there are also a lot of direct lenders that do so by just replicating, in quotes, what banks are doing, by just mimicking banks. And the results that I presented on how direct lenders source loan deals cater to this question. It seems that they are actually not so much relying on what we suggest, big data or fintech. They actually go after borrowers in industries where they have some expertise, where they have the know-how, where they have soft information to be able to interpret the performance and the growth potentials of the borrowers. I think that will be an interesting extension. I cannot conclude that the fintech lending helped or didn't help, and by how much. But what I can conclude from my study is that a lot of direct lenders are in the space by just relying on expertise and information they have accumulated and collected from investing in various sectors over time. I'm not sure if I answered your question.
Yes, okay, thank you very much.
Yes.
Soha, you have any question? Yes, you can ask.
Yes. Dr. Mary, thank you for your presentation. At first, for me, it is the first time hearing about direct lender. My question is direct lenders.
Mohammed, did you get that? Because I think there's, I hear it with, I think there's a problem with the connection.
Suitable source for.
I hear it with breaks. So can you please repeat or just write, because I hear with breaks, I cannot hear you. I think there's a problem with the connection.
So you can ask your question again. Question from Yasin, you can ask. He write in. Yes, Soha?
Dr. Mary, you hear my questions?
Can you please repeat? Thanks.
My questions about direct lenders is suitable sources for emerging market like Egypt?
Yeah, so typically direct lending is present in the US, and not so. I didn't see any activity in emerging markets, or even in Europe, the activity is very minimal. The reason for this is that institutional lenders in the US have been more experienced in providing credit. So if you kind of think, for example, Europe, this is a bank-dominated credit market where borrowers do not feel very comfortable going to an institutional investor to get a loan. In the US, the market is more deep, and the participants, both borrowers and lenders, are more experienced in this type of lending. So the vast majority of direct lending is from the US.
Okay, thank you. Thank you.
Thanks.
Question from Chi.
Yeah, I have one more question. Just want to ask the issue of financial inclusion. So I think I didn't find that in your presentation. So what do you think, should that be included in your study as well?
I'm sorry, I didn't get the question. Can you please repeat? So what do you mean?
The direct, yeah, I mean, my view is that the direct lending or direct loans can have an impact on the financial inclusion as well, meaning that more people have access to finance. So, but I didn't really see that in your presentation. So, do you think that it should be included in your study?
So traditionally, and we can discuss how you define financial inclusion. Typically, financial inclusion is defined as lending to minorities that can be women, different ethnicities, and etc. Direct lenders primarily cater to corporations, informationally opaque corporations. I wouldn't say that, and again, given this, the segment I focus, I wouldn't say that this is an implication from my study. To do so, you can actually look at which are also active at non-bank lenders that issue credit cards, mortgages, and this is this is a different market, and these are very active. And I think that's the setting where you can explore this question, but not in the corporate loan market. In non-bank lenders, typically finance companies, a little bit institutional investors are also active in household finance through credit cards, mortgages. And I think there you can see whether they are indeed more inclusive, or they use predatory lending practices, etc. I think that's an interesting question, but very different from my setting.
Okay, thank you very much. But if you say about corporate, the corporations that in your sample, in your study, that, but if you, let's say the direct lending is targeted at a small and medium enterprises, so wouldn't that be also be, a form of financial inclusion, because you're giving loans to small companies which, through the traditional lending method, they may not have access to. So that's my question. So.
Yeah, correct. But I don't think, and again, I think it's how you define inclusive. Typically, inclusive financial inclusion is used to describe lending to underrepresented minorities. So that can be African American, women. I don't think that direct lenders have this objective. So, for example, lend to medium-sized enterprises led by women. I mean, I cannot address this question. I'm not sure that I doubt that direct lenders have this in their mind. And again, I think it has to be with how you define financial inclusion.
Thank you very much.
They actually go, if you can say that, yes, they go after middle market companies where banks have not been active and they extend more credit, I would say yes, this is a correct interpretation. But whether they enhance inclusion in the market by going after underrepresented minorities and doing so without using predatory lending practices, I think that's something that this study cannot address.
Okay, thank you very much.
Thanks.
Frank Hong?
Yes, Maria, thank you very much for the paper. I like the paper very much. Virtually all the results make very much sense. My question is related to one of the results you mentioned regarding regulatory arbitrage. So you're basically saying that these large banks, they arbitrage these regulations by direct lend to these direct lenders instead of, previously they cannot lend to those borrowers. So my question is that, is this a problem? Because these large banks, they have already done their credit analysis using their internal risk models. They've assessed these direct lenders' profile and decide they can make these lendings to these direct lenders. So is this a problem?
I think it's, okay, so if it's a problem, I think it's a concern. I don't know if it's a problem. I think it's a concern of what actually Dodd-Frank intending to achieve and what it has actually achieved, in the sense that it could be the case, and that's a little bit where the results are pointed to, it could be the case that these borrowers are risky, but they are not any riskier than what banks were, the loans that banks were issuing before. So that means, using with a new regulation and having the new regulation in place, these banks, even if they think, okay, that's not a bad deal, it's a risky deal, but it's not a bad deal. We can get returns from this deal, and it's not a bad deal. It's a risky deal. Let's lend. But now with a new regulation in place, they are restricted from taking this decision. Okay, so it's not borrowers per se that banks did a due diligence on and estimated, evaluate that these are just bad borrowers. It could be the case, and this is with the post-issuance results, that's a little bit where I'm heading to. It could be the case that these borrowers are risky borrowers, but the deals are not bad deals per se. But with a new regulation in place, just banks are restricted in taking on more risk. So what seems to be happening is that instead of banks lending directly because they cannot do this, due to the regulation, they actually source the funds to direct lenders, so they lend more to direct lenders, and they lend to these companies. One possibility is that, well, they can actually not only give them the funds, but they can also give them clientele, they can also give them expertise, so they can be working more closely with the banks. But unfortunately, this is something I cannot observe. Anecdotally, this seems to be the case, so it seems that they are actually offering them some consultation, the banks, to direct lenders, and some clientele, but I cannot really observe whether, if to what extent banks do this systematically.
Sure. Thank you much. Thank you.
Yeah, thanks.
Aguba, you have a question? Aguba? Are there another question? If anyone have any questions, you can open your mic and ask your question, please. Ali Abdul Mutagalli.
Hi, Dr. Maria. Thank you very much for your excellent presentation.
Thank you, Ali.
Thank you. What did you suggest for further research in this topic?
Sorry, can you repeat the question? And maybe if you are closer to your mic.
Hi, are you hearing me?
Yeah, I hear you a little bit blurred. It's like in the back.
I think he asked about the future research.
Future research related to direct lending. So one of the things that and again, I think this is like my interpretation of the literature. One of the things that I think it will be important is to see whether these results are robust if you look at more recent loans, right? So as the market grows and, there seems to be more and more direct lenders coming in, the space of good deals will be evaporated, in the sense that, there won't be any more good new deals. So they may actually start lending to lemons, which is something that happened in the securitization market. So in early years, securitization market was solid, but eventually people start taking more and more risk, because the good borrowers just were not there. I mean, they have taken the money and then they started lending to the lemons. The same could be happening with direct lending. So eventually these markets start giving rise to adverse selection cost. Another, I think, fruitful avenue is to see whether transparency and whether regulation affects the lending decisions of these non-bank lenders. So what I mean with this is that currently at the ECB and in Bank of Mexico, we see a lot of these activities, direct lending activities, being reported to the central banks. Now, the central banks, they don't act, they don't actually limit what direct lenders can do, but direct lenders have to report their activities. In Europe, it's primarily finance companies that do so. The same in Mexico, with Bank of Mexico. We don't have private equity firms or investment management firms issuing these loans. So it's an interesting question, I think, to explore whether just by the fact that these deals now are more transparent, they're subject to some regulatory oversight, whether direct lenders change their credit practices, where they lend less or they try to take less risk, etc., etc. So I think that's another way that future research can go forward.
Thank you, Maria.
Thank you.
Are there another questions? If anyone have any questions, you can ask open your mic and ask your question. And Naguib?
Hi, Maria. Thank you for your presentation.
Thank you.
Hello?
Yes, yes, I can hear you. Thank you.
Yeah. Can we get a copy, please, from your presentation? Is it possible?
Yes, yes, I can, of my presentation, yes. Of the PowerPoint, you mean? Yes, I can send it to, Mohammed.
Can we send you email and we get the copy? It's okay? It's
yeah, that's also a possibility. Yeah, you can send me directly. Yeah, that will be also better. Yeah, I think that's a better idea. You can actually send an email to me directly, and I can provide you with a copy.
Oh, thank you so much. Thank you.
Yeah, thank you.
Is there another question? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Maria, for your contribution and your effort. It's really an excellent presentation. Thank you very much, everyone joined us today, and thank you very much for taking the time out to present to us today, dear Professor Maria. It's been really appreciated. Thank you very much.
Thank you all. Thank you all for attending my workshop. Thank you for your questions, and I look forward to seeing you in person sometime soon.
Yeah, and I hope to see you soon in Egypt.
Yes.
Yeah, you are very, very welcome.
Thank you. Thank you, everybody. If you have any follow-up questions, just feel free to send me an email. Okay, thank you so much.